All right, let's talk about international stocks. Why should you even bother with them? It's a totally fair question. I mean, why would you put your hard-earned money into a company in a country you might not even be able to find on a map? Well, today we're going to break down exactly why looking beyond your own borders isn't just some wild adventure, but actually a crucial strategy for building a stronger, more resilient portfolio. So let's start with the biggest challenge. And believe it or not, it isn't something you'll find on a stock chart. It's actually in our own heads. It's a common psychological blind spot that might be quietly unbalancing your portfolio right this very second. I mean, let's be honest, right? For a lot of us, the idea of investing in what are called frontier markets, places like Nigeria or Kuwait, that can feel more like a risky gamble than a sound financial plan. It's only natural to stick to what we know, because what's familiar feels safe. But is that feeling of safety just an illusion? That's what we need to dig into. And this tendency actually has a name. It's called home country bias. It's this simple, very human preference for investing in what's in our own backyard. It feels comfortable, sure, but that comfort, well, it comes at a cost. So just how powerful is this bias? Get this. The average American investor puts a whopping 70% of their stock portfolio into US companies. Now, on the surface, that might sound totally reasonable, but that number is hiding a massive imbalance. And here's the reality check. The US stock market makes up less than half of the entire global market. So that 70% domestic allocation, it means the average investor is basically ignoring more than half of the world's investment opportunities. It's kind of like going to a massive global buffet and only eating the hot dogs. You're missing out on so much. Okay, so the good news is, fixing this imbalance doesn't require a PhD in geopolitics. There's a beautifully simple, elegant strategy that experts have recommended for years to get global exposure without all the headache. It's called the passive 3-fund portfolio. And the idea is just so simple. Instead of trying to pick individual winning stocks or countries, you own the entire market through just 3 low-cost index funds. One for the US stock market, one for bonds, and the crucial one for our chat today, a total international stock market index fund. With that one fund, you instantly own a piece of thousands of companies all across the globe, from Tokyo to Toronto. So why is this so important? Well, the number one reason comes down to defense. It's all about protecting your wealth from what you could call home turf risk. You just really don't want to have all your financial eggs in one single country's basket. Because here's a huge lesson from history. No single country stays on top forever. Market leadership isn't a permanent title. Instead, what we see is performance moving in these long, predictable cycles between the US and the rest of the world. And you can see that pattern beautifully here. It's this constant tug of war for who's in a lead. International stocks were the winners through the 70s and 80s. Then the US took over in the 90s, and then it flipped right back. Historically, these periods of dominance last about 8 years. But check this out. The most recent US run has lasted much longer, which led a lot of experts to believe a flip was seriously overdue. And that overdue flip, well, it's exactly what happened. This quote from Barry Ritholtz just nails it. After a decade and a half of US leadership, international stocks surged big time in 2025, leaving the domestic market in the dust. So you see, this isn't just a theory, it's a real cycle playing out right before our eyes. Okay, but here's the super important point. Diversification isn't some magic shield that works 100% of the time. During those sudden, sharp crises, like in 2008 or 2020, everything starts moving together. Everything tanks at once. And those benefits of being diversified, they kind of disappear for a little while. But then, as the panic subsides and markets calm down, they spread out again, which really proves why it's such an essential long-term strategy. But hey, international investing isn't just about playing defense. It's also about playing offense. It's about tapping into these incredible growth opportunities that you just can't find if you only stay at home. Seriously, think about it. Where do the world's most dominant luxury brands and high-end car companies come from? Mostly Europe. The raw materials that are powering the whole green energy transition, like lithium, largely from Latin America. And the absolute powerhouse for semiconductors and factory automation, that's Asia. A US-only portfolio is almost completely cut off from these global giants. So when you go international, you're buying into different flavors of markets. First up, you've got the developed markets. These are the big, stable, industrialized economies. Think Canada, Japan, France. They're usually considered the safest bets outside the US. Then you have emerging markets, places like China, India, and Brazil. Now, these economies are growing way faster, which can mean much higher returns on your investment. But the trade-off? There's more political and economic uncertainty. It's that classic higher risk, higher reward scenario. And finally, you get to the frontier markets. You can think of these as the next wave. Smaller, developing economies like Nigeria or Kuwait. They definitely carry the most risk, but they also have this powerful secret weapon for diversification. Their markets often dance to their own beat, moving completely independently of what's happening in New York or London. And this pretty much sums it up perfectly. As you move from developed to frontier, both the potential risk and the potential for growth go up. A good international fund will give you a healthy, balanced mix of all three. And there's one more huge benefit, especially right now: price. After so many years of strong performance, a lot of US stocks are frankly pretty expensive. By contrast, many international markets are basically on sale, trading at a really attractive discount. That lower starting price gives you a potential cushion and a much longer runway for future growth. So let's bring this all home. The crucial question is, how do you find the right balance? How do you put all this together to build a truly resilient, all-weather portfolio that's ready for whatever the global economy decides to throw at it? Well, a more balanced portfolio might look something like this. Instead of that 70 or 80% bet on a single country, this 65-35 split is much more in line with what the actual global market looks like. And the research really backs this up. The data suggests that dedicating somewhere between 30 and 40% of your stock allocation to international markets is the sweet spot. It's enough to seriously reduce your risk and capture that global growth without taking on too much extra currency or political risk. And let's be really clear about this, you do not need to be an expert who can predict which country is going to boom next. By simply holding a single, broad, total international index fund, you get exposure to all of it: the developed, the emerging, and the frontier. It's your portfolio's simplest and, honestly, best defense. So that brings us to the final question. After seeing the cycles of history, the hidden risk of home bias, and all the opportunities waiting out there, it's time to look at your own investments and ask yourself, is my portfolio built for the world as it is today, or is it still built for the world of yesterday?